Good afternoon. Good afternoon. Good afternoon. Play some music or something. Good.
Ladies and gentlemen, we're about to begin. Please take your seats. Thank you.
It's not there. Good afternoon. Chair Gensler, welcome.
Thank you so much, Brian. It's good to be here.
Good to see you. Just, if I could ask everyone. Chair Gensler,
Brian.
thank you for joining us. We appreciate it. We have a packed ballroom here in New York, and we very much appreciate you taking the time to join us remotely. And I have to say up front, we've had a terrific morning with a number of your colleagues who have joined us and have shared a lot of interesting perspective and thoughts on some of the rulemaking. So we appreciate that, and also appreciate your willingness to meet with MFA throughout the last couple of years. You've always made time, you've always sat with us, heard our arguments, and have always thoughtfully engaged, as well as reaching out to talk to us about some rules in the pre-proposal stage. So we thank you for that. I should note for everyone in the room that Chair Gensler's remarks are available in the MFA conference app, so you can go ahead and take a look at his remarks. Chair Gensler will make about 15 or so minutes of remarks, and then we'll have a Q&A afterwards. So Chair, thank you very much. Over to you.
Thank you so much, Brian. And as is customary, I'd like to note that my views are my own as SEC Chair, and I'm not speaking on behalf of my fellow commissioners or the SEC staff. With that out of the way, let me turn back to the 1990s. And you might remember them well. The 1990s were a decade of Michael Jordan and the Chicago Bulls. Of course, the Cold War was over. It was the dawn of the internet. And let us not forget the Spice Girls. Seinfeld was on TV, and Bill Clinton brought blue jeans and Domino's delivery to the White House. You're thinking, where am I headed with this? Well, the 1990s also was pretty relevant for the private fund field. Well, Brian, the Managed Funds Association was founded in 1991. But Congress also passed amendments in 1996 to the securities laws, and included in those amendments was a new exception from registration allowing private funds to have an unlimited number of qualified investors. That same 1996 law included an important provision that the Securities and Exchange Commission rulemaking had to consider efficiency and competition as well as capital formation, in addition to investor protection and the public interest. Now, the 1990s was also when I became a father of three remarkable daughters. And yes, I'd have to say I watched some great rom-coms, Meg Ryan, Julia Roberts, and the like. I also had a career shift in the late 90s, in 97, in fact, that took me the next year up to Greenwich, Connecticut. And it was a fateful weekend in 1998, just prior to long-term capital management's failure. I would say impending failure. Let's now fast forward to the 2020s. I'm not talking about Biden versus Clinton or generative AI versus the internet or even Taylor Swift versus the Spice Girls, though there may be some things on which Taylor and I might agree. Instead, I'm going to focus on private funds. Advisors now report more than $25 trillion in private fund gross assets. Again, $25+ trillion in private fund gross assets amongst tens of thousands of funds. The reported assets today surpass the size of the entire commercial banking sector at $23 trillion. Back in 1998, as I was being sent up to Greenwich, Connecticut, the industry had about $800 billion to $1 trillion in assets with only a few thousand funds. So now 25 trillion, 25 years ago, give or take $1 trillion. Back then, that represented 20 to 25% compared to a $4+ trillion banking sector. The private fund industry plays an important role in each sector of our capital markets, whether it's equities, treasuries, corporate bonds, mortgages, municipals, loan originations, many other parts of the markets, well, even maybe in the crypto markets. It's intertwined with the derivatives and funding markets, such as the repo and reverse repo markets. It participates in capital formations from startups to late-stage companies. You know this. You know this well. It also plays an important role for investors, such as retirement funds and endowments, and standing behind those entities are a diverse array of teachers, firefighters, municipal workers, students, and professors. Subsequent to the 1990s, as you also know, we had the 2008 financial crisis, and in response, Congress once again acted 10 years or 12 years or so after the fateful days of long-term capital management, but they gave the SEC some new authorities, including regarding private funds. First, Congress repealed the exception that most private fund advisors previously had relied on to avoid registration, causing private fund advisors, with some narrow exceptions, to register with the SEC. And secondly, Congress also directed the SEC to collect information from private funds, and I'm going to quote, as necessary and appropriate in the public interest and for the protection of investors and for the assessment of systemic risk, end quote. We take congressional mandates seriously in the context of a three-part mission. You know it. It's protecting investors, maintaining fair and orderly and efficient markets, facilitating capital formations. The markets should work for the benefit of investors and issuers alike, not the other way around. Now, I recognize we may have different clients. The MFA's clients are your members, of course, largely investment advisors to private funds. The SEC's clients, though, are the American public, investors, and issuers alike. And much of the SEC's work in updating our rules is to keep up with today's ever-changing technology and business models, and we're focused on promoting fair, orderly, and efficient markets, which helps protect investors and facilitate capital formation. It's not the other way around. It's not that we're trying to promote markets that investors and issuers work for the markets. It's kind of the other way around, if you can imagine. And I'll speak in terms of what we're doing in terms of efficiency, integrity, resiliency that maps into the middle of that mission. But back to efficiency. You probably are familiar with Alfred Winslow Jones. If not, you might put his family or descendants on your Christmas card list and holidays list, because he's the father of hedge funds. He started the first one in 1949, and he created the 20% performance fee structure. It's said that he modeled it on Phoenician sea captains who took the same in profits, 1 out of $5. By my time on Wall Street when I was at Goldman, this had led to the 2 and 20 model. Well, today, private fund advisors receive multiple levels of and types of fees, from management fees and performance fees that you know, but that's not only the only fees, it's also consulting, advisory, monitoring, servicing, transaction, director fees, amongst others. Average private equity fees were estimated to be 1.75% and 20% performance fee in 18 and 19. For the largest private equity firm, those fees might even be higher. Average hedge fund fees, a little bit lower, 1.4%, 16% performance fees as of 2020. Taken together, you could see how this arithmetic would lead into fees that might add up to 3 to 4% in private equity or 2 to 3% in hedge funds. You know the numbers better than I am, but I'm just ballparking and averaging. Fees and expenses range well into the hundreds of billions of dollars each year. That's the math when you have $25 trillion of assets under management. So we have a number of projects across the capital markets around efficiency, but most important to this group is around private fund advisory proposal. The proposal uses the tools of transparency and market integrity to help promote competition and efficiency. And this ties directly to those 1996 reforms. And again, I'm not talking back to Meg Ryan and the Spice Girls, but Congress. Congress said that we had a role, the SEC, to consider efficiency and competition in the capital markets. Congress didn't cabin those 1996 reforms only to retail investors or one segment of our market. They didn't leave out so-called sophisticated investors. The proposal's new transparency would relate to fees, expenses, performance, and side letters. Now, as to market integrity, annual audits would be required. The proposal also would prohibit certain activities such as seeking reimbursement, indemnification, or limitations of its liability, including breach of fiduciary duty in providing services. The second thing we think a lot about is integrity and disclosure. Congress gave the SEC an important role of promoting market integrity and disclosure to help investors. This facilitates capital formation and builds trust. This lowers the cost of capital for issuers, raises returns for investors, helps increase participation. Integrity and disclosure facilitates basically what's best in capital markets and guards against the worst. Now, at the SEC, we have a number of projects focused on market integrity and disclosure. I'm just going to focus on some that you might have the most interest in, all 5 of which relate somehow to Dodd-Frank mandates and reforms. Dodd-Frank, passed after the 2008 crisis, mandated 2 rulemakings to bring greater transparency around securities lending on the one hand and short positions on the other. They had not been completed when I got here 2 years ago, but thus we have proposals that would reduce information asymmetries between borrowers and sellers in the securities lending market and make aggregate data about large short positions available to the public, mandated by Congress. Further, we have 3 outstanding proposals authorized by Dodd-Frank related to investment advisors' custody of client assets, beneficial ownership, and large position in securities-based swaps. In the wake of the Bernie Madoff scandal, you might not recall it, but Congress gave the SEC updated authorities that investment advisors should safeguard client assets over which they have custody. Thus, we propose safeguarding rule, updating our prior custody rule. In particular, Congress gave us authority to expand advisors' custody rule to apply to all assets, not just funds or securities, but all assets. And further, investors would benefit from a proposal's changes to enhance protections of qualified custodians provide. Another area, in 1968, Congress mandated that large shareholders of public companies disclose information that helps public understand the ability to influence and control that company. It was under the Williams Act. Beneficial owners of more than 5% of public companies' equity who have control intent had 10 days to report. Lots have changed in 54 years. Today, the markets are dramatically faster, and Congress recognized this, and Dodd-Frank gave us authority to shorten this deadline. Thus, we propose cutting it in half. Lastly, Again, in Dodd-Frank, after the crisis, Congress granted us broad authority with regard to securities-based swaps, including credit default swaps, which played such a leading role in that crisis. But back to long-term capital management, if I can, there was risk-taking in the total return swap area, another form of securities-based swap. So given this history, given the authorities Congress gave us, and not even to mention what happened in Archegos, I supported the Commission's proposed rules to require prompt disclosures of large securities-based swaps positions, as well to strengthen investor protection in securities-based swaps. Lastly, let's turn back to the 1990s, if I might, for a moment. When my youngest daughter, Isabel, I said I was a proud papa of 3 new daughters in the 1990s, but when Isabel was but a year old, she's sitting on my lap, the phone call comes in from Secretary Rubin, and he had just been discussing long-term capital management with Federal Reserve Chair Alan Greenspan. They asked me to go up there with Peter Fisher from the New York Fed. After visiting the fund that Sunday, I called back to Secretary Rubin and said it would be unlikely the fund would last past the upcoming Wednesday. I think Bear Stearns was going to pull the prime brokerage relationship. And though I shared with him estimates of the first order losses of the direct counterparties, I said at best, it only would be a guess as to the possible systemic effect to the financial markets and into the broader economy. You see, and these are all public figures, the fund had $1.2 trillion in derivatives booked in the Cayman Islands, no less. It had over 100 billion plus balance sheet on only 4 or 5 billion of net asset value. Subsequently, I was asked to staff the President's Working Group report, where in that report, we found, quote, that the events, quote, highlighted the risk of excessive leverage and the possibility that problems at one financial institution could potentially pose risk to the financial system as a whole, end quote. This was about a hedge fund. This was 25 years ago. History is replete with times when tremors in one corner of the financial system, one financial institution spill to the broader economy. When this happens, the American public, bystanders, frankly, on the highways of finance, inevitably get hurt. Investors and issuers inevitably get hurt. Let's just forget 10 years ago, the financial crisis itself. It's actually 15 years ago now, but 10 years after long-term capital management, millions of Americans losing their jobs, their homes, small businesses shuttering, and so forth. So in Dodd-Frank, Congress did put in place new requirements, as I mentioned earlier, about, yes, certain private fund registration, and yes, reporting of private fund advisors. The SEC put in place something called Form PF a dozen or so years ago, but a lot's changed since then, and that's why we have these 2 proposals outstanding to update them. One's related to current reporting, and I'm glad that tomorrow we're going to consider staff recommendations on a possible adoption with regard to that rule. And then secondly, working with our colleagues at the CFTC, we have a proposal, among other things, that would expand reporting the requirements of large hedge funds. Lastly, I'd note we have important projects around efficiency and resiliency in the treasury markets, and private funds have a significant investment in this $24 trillion markets. Private funds also provide various functions and operations in that market as well. So these projects in the treasury market, you've, of course, commented on. I think we've gotten 5 letters alone on our treasury dealer proposal, or more precisely, the dealer trader proposal. But we have that, we have it on platforms, we have facilitating greater clearing. I would say that projects are important in part because hedge funds can create risk and financial stability through the use of leverage through counterparty exposures. You see, hedge funds' exposures to repurchase agreements, reverse repurchase agreements, treasury securities have increased in the recent years. And moreover, in the last few years, many hedge funds are receiving repo financing in non-centrally cleared bilateral markets where haircuts or initial margin requirements are not necessarily being applied. So lots have changed since the 90s. Of course, my daughters are grown up. The technology of today makes the technology of that time seem quaint. We're talking generative AI, not just the internet. And though I still do enjoy Sleepless in Seattle and Notting Hill, the projects I've discussed are designed to update the rules of the road for private funds to meet today's times and ensure that intermediaries too work for investors and issuers alike. And Brian, it's over to you.
Great. Well, please join me in giving Chair Gensler a round of applause. Thank you for joining us. So I have to say up front, as I'm listening to the 90s references, I'm feeling older, and I'm also remembering both good and bad times from high school. So thank you for that. I think many of us in the room, Chair Gensler, when we hear LTCM, we think 25 years ago. Markets have evolved, risk management systems have improved, there's been regulatory action to implement reporting requirements, Form PF. Your sister regulators in the banking agency have changed their regulations to require margin and improve risk management. Help us understand why LTCM 25 years later is still the right touchstone for why you think about regulation for this industry. It just seems like it's not the right framework given where we are today.
I couldn't disagree more with you, Brian, but you and I have lively discussions, and I just thought I'd say it. Look, we've learned a lot about systemic risk. We've learned it in the last 6 or 8 weeks in the regional bank sector, or even in Europe with Credit Suisse's events. We're not going to, economics is not going to repeal that there's systemic risk from time to time. One corner of the market that propagates out elsewhere. Long-term capital management was a situation that was quite highly levered. Prime brokerage relationships, principally it was with the old Bear Stearns, but it also had counterparty relationships with a dozen or 15 other major banks. It was interconnected with a lot of banks. Fast forward 25 years, the private funds area is multiple times bigger, 25 times bigger, by the way. It has now surpassed the commercial bank sector in terms of scale size. It is highly interconnected with the commercial bank system through prime brokerage. As I noted, a lot of those prime brokerage relationships are providing zero or low haircuts in the whole system, so a lot of leverage in that system. And that intersection between hedge funds and commercial banks. So I think that actually it highlights just one way that risk can propagate, but it's how the hedge fund community intersecting with prime brokerage, highly levered, use of derivatives, I think it's very relevant. Obviously, the markets are different. We trade 24 hours a day in a way, we trade technologically in a way, generative AI changes a lot of things as well. This and your and my conversation might go into sentiment analysis and change markets. But still at the core, you still have the risk of interconnectedness, herding, and regulatory gaps, which are the three sort of key lessons that I think came out of that long-term capital management.
Yeah, and our industry is very dynamic. New funds start, funds fail, they go out of business. That's part of the industry. And I think in that 25-year period, we haven't really seen another example that would trigger the type of regulation that we heard FSOC talking about 2 weeks ago. So I want to pivot to FSOC and the stated desire to expand regulation for non-bank entities. And again, LTCM popped up in that context as well. Let's fast forward 5 years. Is this industry going to be regulated by the SEC and prudentially by the Fed and Treasury? How are these regimes going to work together? How does it play out?
I think that depends on how events unfold in the next 5 years. I supported that proposal. It's just a proposal of the Financial Stability Oversight Council, basically to get back to where we were and to allow the FSOC to consider any sources of risk in the non-bank sector. But in terms of the hedge fund community, I mean, we have a number of resiliency projects, I think really critically around the treasury markets and central clearing and that dealer trader rule that I talked about. But I also think the additional information we would have available to us through the updated Form PF. But again, it depends on the events of the next 5 years and how significant any 1, 2, or 3 hedge funds got. But I really do think that the critical piece of this is our oversight of this industry and some of the proposals that we have on the table that you've commented on. And lastly, the relationship, the prime brokerage relationship with both commercial banks and broker-dealers.
Yeah, I want to switch gears. One of the comments we've made, Chair Gensler, throughout the rulemaking is our focus on the collective impact on these rules on the industry in terms of forcing consolidation. As I mentioned earlier, our industry is dynamic, lots of new funds coming to the market. When you look at all of the proposed rulemakings in aggregate and the cost of implementation, we believe firmly that that is going to result in consolidation. Small firms, new launches are going to have a hard time bearing those costs, which will mean that the large funds are going to get bigger, which somewhat feeds into the argument you're making around systemic risk. As you're sort of pushing entities to consolidate and get bigger, you know, that does, I suspect, in your view, lend itself to the systemic risk argument. How do you think about this competitive dynamic around the big getting bigger as a result of the cost of compliance and the resource requirements?
Look, Brian, you raise good points. Finance, and this is since antiquity, it's not about the 1990s when you were in high school, but finance tends towards centralization. It does, and there's a lot of economic reasons of network effect, data, aggregation, and the like. But the various proposals that we have outstanding, we take into consideration comments about the economics and how to best promote the competition and efficiency of each of these markets. And I think that on balance, that's what we're doing.
We were encouraged to see last week the reopening of the 13 DG rule to take into account the new economic analysis from the SEC. As you look at some of the other rulemakings, particularly the private funds rule and the dealer rule, do you foresee additional economic analysis from the SEC that would lead to extending or reopening some other comment periods?
We do this from time to time, and it's not the one that you mentioned last week is not the only time we've reopened, but I would encourage all of your members, if you have comments on any of our outstanding proposals, submit comments. I mean, the Managed Fund Association has found a way to do at least 5 on the dealer trader rule. And
you're keeping us busy.
I mean, Brian, listen, we benefit.
We don't want to do it.
No, actually, if your members are dealers, you should register. You should want to do that, by the way. But the comment letters help us, and if you have additional economic analysis on any one of our outstanding proposals, we benefit from looking at that analysis. And Jessica Wachter's team, it's just a terrific team here at the SEC. We'll take a look at it. And the commissioners will get the benefit of it.
Well, we think the economic impact of these rules in aggregate and certainly some of these rules in individual nature are very problematic for
But can I say this, Brian? It's about the economics ultimately again, we have different client bases. The Managed Fund Association, which I have respect for and deep respect, our clients are the 330 million Americans. So it's about what it does for investors and issuers alike, and benefiting that. And that may, in fact, mean that in the middle, the market, the intermediaries, the asset managers in the room in the middle may find more competition, more efficiency means a little lower profits and less economic rents in the middle, and higher resiliency for the American public. And so there's a bit of a trade-off, but the trade-off is really investors and issuers getting the benefits of markets and not investors and issuers working for market intermediaries to get more profits.
So one last question, Chair Gensler. Fast forward 6 to 12 months from now, any insight you can share on what potential issues are to come for our industry in terms of potential rulemakings, and how you think about prioritizing, finalizing many of these rules at the same time? So help us understand what the next 6 to 12 months look like.
We're going to continue to do what we do well. We're considering potential adoption on 2 rules tomorrow, but we're going to continue to do that, moving through that which is out there proposed. I think that we live in some uncertain times, Brian. It's going to step away from the proposal rule sets, but just look, we still have economic uncertainties, whether that's in Eastern Europe with a hot war still going on. We still have uncertainties around central banks around the globe trying to address the various inflation that's in many economies, not just ours. And we've even got near-term uncertainty to get through this debt limit issues, which of course would be quite unsettling, and that's saying it mildly, but quite unsettling to our capital markets and to our economy. It's an honor to be in this job and a great privilege, and we at the SEC, 4,600 people strong, will continue to do what we do well and try to be investors and issuers a cop on the beat, but also monitor markets and try to update our rule set for these modern times.
Well, Chair Gensler, we certainly appreciate you joining us today. MFA tries to be very constructive in the rulemaking processes, so I appreciate you acknowledging that. You and your staff have always been very open and available. I look forward to seeing you on our next Zoom call in the next couple of weeks, I suspect. But thank you very much.
Do I get a picture of you in high school?
Just picture a lot of hair back in high school.
Yeah, my hair was a little different in high school.
It's all been downhill since then. But thank you for joining us. We appreciate it, and we look forward to seeing you again soon. Thank you.
Thank you so much.
Great. Please continue eating. I'm now going to invite my colleagues Jen Hahn and Jillian Flores to join me on the stage, as well as Brian Daly, partner at Aiken Gump, to sort of reflect on what we heard this morning from the various speakers and talk a little bit about what we expect to come in the next couple of months. Thank you.
It's all